So there are two methods. Number one, percentage of sales method, which is easy one, and then aging of account receivable method, which is if you give credit, longer period of time credit to a customer, so that customer who is given only 15 days to pay, the chances are that he is going to, he is not, the chances of his uncollectability is less as compared to that customer whom you have given 90 days. All right. So chances of getting uncollectible is high for longer period of time. So we age the account receivable. So we'll learn that. So percentage of sale method, sales belongs to income statement. So we call this income statement approach, where receivables are on balance sheet. So we call this balance sheet approach. So we learn both methods. So number first, percentage of sale method, simple. You multiply the percentage that is not going to be collectible with your this year sales. That's it. And we call this is uncollectible expense. Expense. So expense will directly go to income statement. All right. Again, let me repeat one more time. So percentage of sale method. So this percentage is coming from your history, your experience. Okay, if we have a sale 1% or 2% or 1.5% or 0.% or 3% or 10% are uncollectible. So you in advance plan in your new sales that okay, this much is not going to be collected, and that amount you charge as an expense, and expense goes to income statement. All right. So let's do this illustration so that we further clarify this percentage of sale method. Number one, we have a scenario here, and that is, assume it is September 29, 2012, and Apple Incorporation accounts have these balances before the year-end adjustments. Okay, so we have account receivable that is 11028, and we have uncollectible accounts allowance balance already set up. All right, now suppose Apple Incorporation credit department estimated that uncollectible account expense is 0.0005 of total revenue, which are 156,508 million. So if you multiply 156,508 with 0.0005, answer going to be 78 million. All right. So the entry that records uncollectible account expense for the year also updates the allowances as follows. So you already have the allowance, previous allowance that is coming from, because this is shown on balance sheet. This is also shown on balance sheet, right? This is contra account of asset account, which is account receivable. So suppose Apple Corporation estimate uncollectible debt is 0.0005 of 156,508. So the entry is going to be uncollectible accounts and uncollectible expense. All right. So what is the entry? How much is the uncollectible? We just multiply this with the sales. All right. Estimated sales 156,508 and estimation of uncollectible 0.005. So this is the estimated that this is not going to be received. When this is not going to be received, you expense it. So when expense increase, debit. So what is the Corresponding account is the allowance. So uncollectible expense to uncollectible accounts allowance. Entry going to be uncollectible expense 78. Expense increases, debit. Allowance for uncollectible, contra account. If account receivable increase, debit. If contra account uncollectible allowance increases, credit. Entry complete. Debit to credit. All right. So this we post it to our P accounts. So we have a new adjustment that for the new sales of 156,508, this much is not going to be received, and the balance is $88 million that is not going to be received. And 78, this is the expense. This is will go to here. So what is the amount that will be shown on account receivable? Account receivable net of receivable. So 11,028 minus 88. Answer going to be 10, 4, 10, 9, 10940. All right. So now anything bad happen will affect this allowance, but the net is, it remains the same. So there is no change on this net figure. Maybe there is a change in here and here, but ultimately the net effect is the same, so that balance sheet is not disturbed, your cash budget is not disturbed. We'll see that. When we do some examples, we'll see that. Now, allowance method, which is balance sheet approach, which is aging of the account receivable. Simple, you just multiply account receivable with its estimation. For example, we example here. For example, okay, we have a number of categories of account receivable: 15 days, 30 days, 60 days. So chances of being not collectible in 15 days are 0.1%. It is 0.2%. It is for 60 days, it is 5%. You multiply just the amount here and add it, that would be allowance method. So let's have the example here. So we do have the same example for Apple Corporation. So they have a allowance already 10, and they have account receivable 11028. Now the computerized accounting packages ages the account receivable as follows here. So in 1 to 30 days, company gonna receive 10164. So total balance is 11,11028. This amount 11028. So they segregate it into number of days according to their age. So 1 to 30 days, this much amount is going to be received. 31 to 60 days, this much 600 million is going to be received. This is in million. 61 to 90 days, 200 million is going to be received, and over 90 days, 64 million is going to be received. And you find out, okay, so chances that it is collected early have a chances that is not collectible is low. So that's why it's 0.75. You multiply 10640 with 0.75. So if you rounded it, it would be 76 million. So chances of 600 million is not going to be received, 1% increased. That 1% of the 600 is not going to be received at 6 million. 61 to 90 days, 5% of the 200 is not going to be received. So it is 10 million. And chances that over 90 days, if we allow credit for a customer of 64 million, chances are that among this 10% is not going to be received, which is 6.4. If you rounded it, it will be a 6. So total 98 million is not going to be received. So remember, this is total balance. All right, total balance. So total balance of the account receivable is 11,028, and total balance of allowance is 98. Total balance. It is telling you total balances. So remember, total balance mean here 98. All right, 98. So allowance for uncollectible is 98 minus 10. So we need to make entry of allowance for 88. So if you go over there, it shows us total of 98. And how we make it balance? If you add 88 more. So this needs entry. This is going to be, we have to adjust. So remember, percentage of sale method tells you this amount, but aging method tells you total balance. That is the difference between these two. If you go back here again, see, the percentage of sale method gives you the adjustment, and you make entry of the adjustment. An uncollectible expense 78 to allowance for uncollectible 78. So this 78 is going to tell you this adjustment, but aging is going to tell you is going to find you the total balance. So it means adjustment is you need to find out by plug figure. All right, so it's 88. So total balance is 98, beginning balance 10, 88. So entry gonna be expense to uncollectible 88. So many students, they confuse and they couldn't pay attention to this 98 and this stuff. They write down 98 here and 98 here, which is wrong. All right, guys, do you understand? PD, David, Sufyan,
Yes.
Venetia, Mirvia,
Yes.
Yes.
Havarun, Momo, Priscilla,
Yes.
Mirko,
Yes.